Like to start with a poll. We love to ask you poll questions at all times on our live stream page. We also like to send them out via social media. Anytime you see them, respond, and I'll see what some of your fellow viewers are saying and thinking. Recently, we asked you about technical indicators, particularly candle patterns. And the question was, in a downtrend, you have a long down candle followed by a long up candle. Day two closes about 75% of the way back up through the first candle's real body. That's kind of a key point there. And which pattern is this? Doji, incorrect. That's actually where the open and close are right about the same. Bearish engulfing pattern really only happens in an uptrend, so that's impossible. A bullish engulfing pattern, close but not quite. So bullish engulfing pattern would be if day two was closed above the open of day one. So the correct answer, which 59% of you said, was the bullish piercing line pattern. The bullish piercing line, the bullish engulfing patterns both pop up during downtrends. They both are bullish reversal candles if you would see them pop up on your chart. If you're unfamiliar with some of those candle patterns, go to our chart school, free set of resources where we include a lot of chart patterns and give you examples and ideas of how to navigate those. Continuing on with our wrap the week segment, looking at this week, I often talk about how Friday is a chance to look at how the markets have evolved in the last 7 days, the last 5 trading days. In this case, the shortened week after the 4th of July holiday. And overall, to be honest with you, it was sort of a mixed week. There were certain points in the week where it felt like distribution was accelerating, and I think Thursday sort of felt like that. Wednesday into Thursday, all of a sudden you saw a bit of a rollover, and even though they recovered a little bit, it had been a gap lower, and it felt like there was some severe weakness. Today, completely turning. You see rates going back higher, and it's worth noting that rates are moving in line with the markets here, and so it's sort of the level of the 10-year is indicating strength in the economy, according to what the market is saying. My friend Matt Maley at Miller Tabak pointed that out to me this morning. So overall, higher rates today indicating we are not at peak growth, apparently, for one day only, and you're seeing stocks continue to push higher. Let's do very quickly a market recap here, seeing what happened just today. We'll look at our wrap the week chart and look at the last 4 trading days and see what's happened, and then we'll finish off looking at the Mindful Investor Live chart list. So the stock market in the form of the S&P 500 finishing up about 1.1%, closing just below 4370. That's a new all-time high and a new all-time closing high for the S&P. So if you're looking for evidence in the form of price, you certainly got it. For the first time, and I feel like forever, we've had mid caps and small caps outperforming. Small caps have been underperforming pretty consistently in recent weeks and months. Today, again, a mean reversion trade with financials number 1 out of all the sectors, energy number 2, and small caps leading the way higher. Nice bounce higher for small caps. And small caps over the long term have performed much better on a relative basis. But if you look at the last couple months, that's completely changed as the small cap performance has been overtaken by large and mega caps. The Nasdaq pushing higher as well, underperforming the S&P by a little bit, and the VIX just around 1620. Interest rates back higher. So after being in the 120 handle yesterday, we're back to around 136 or so on the 10-year yield. The TLT, which is our proxy for bond prices, coming off pretty consistently today, down about 1.4%. And the dollar, which is in a pretty decent uptrend for a little while, fueling U.S. outperformance of global markets, down about 0.25%. I would argue that uptrend in the dollar is still very much in play. We've talked about the strength in gold and sort of that bullish reversal, that bullish engulfing, not the bullish engulfing pattern, the bullish divergence, momentum divergence, with lower lows in the GLD, higher lows in the RSI, and that following through today with the GLD pushing higher, really accelerated into the close yesterday and continuing that move higher. Copper prices moving higher as well. There's been a relatively mixed or non-correlation between stocks and copper, but today that's sort of going back to everything in positive mode. Cryptocurrencies getting a bit of a bid finally after huge distribution in recent weeks. Bitcoin up only 1.8%, which is relatively low for a very volatile asset class, but overall in decent shape. We're going to come back to sort of the long-term charts when we get to the Mindful Investor Live chart list. What I want to do now, though, is go to the wrap the week chart. We're going to look at the last 4 trading days because it was a shortened holiday week, and we can look at our major asset classes and see how they've traded. If you follow along with my green mouse cursor, you can see where the S&P has been and what the other asset classes have done as well. So starting the clock at the end of last week, the S&P here essentially flat for the week, up 0.4%. Most of that came today, really, because yesterday I was sort of down on the week, and a nice strong finish to make a new closing high. So the S&P up 0.4%. In green, we have the dollar index using the UUP, which is essentially flat, down 0.1%. Here we have a cluster of things. We have crude oil here down 1%, Bitcoin down 1%. In purple, we have small cap stocks down 1.3%. The weakest performer was the emerging market index, EEM, which is down 2.3%. Everything else outperformed the S&P. Again, the S&P up 0.4%, up 0.7% was the Nasdaq 100, the Qs. Right here in pink and red, we have the bond prices using the TLT up 1%. Finally, gold, the strongest performer out of the mix, up 1.1%. So it was interesting. As of Thursday's close, bonds were the top performer. You talk about rates really accelerating to the downside and the implications of that. And again, what we've seen from the market with rates coming off, with the market selling off midweek, it certainly has changed a bit from weak bond yields going down being a tailwind for growth stocks, as opposed to now it's sort of weaker interest rates indicating weaker economy, weaker economic conditions and peak growth. So rise in yields today, rise in the market, rise in growth, and especially the rise in cyclical. So that's how the week played out. And again, overall, a relatively flat week. If you look at some of the previous weeks with a lot of volatility, it was feast or famine during the week, and certainly ending in a position of strength there. Let's finish off our Wrap the Week segment going to the Mindful Investor live chart list. As a reminder, we have this chart list linked up to my blog on StockCharts.com. So if you go to the articles tab, go to my homepage, which is called the Mindful Investor, and you can get this free chart list right at the top. There's a gray button with a link to the live chart list that'll get you to this point. You can save all the charts, send them to your friends, share them on social media, whatever you would like to do. We'll start with the market trend model. This is a market trend model using weekly data that I created years ago and have just followed as a general trend following mechanism running in the background. It tells me basic things about risk on versus risk off, long-term and short-term trends, and giving me a sense of the bias with which I should look at all the other charts during the day. This is the first chart I look at every morning, by the way, just to make sure I orient myself to the long-term trend. And the long-term model, using the longest weekly exponential moving averages, turned bullish about a year ago, just over that mid-June of last year, has remained very constructive. And that really just indicates the strong upward trend that we've seen in stocks. We're making new all-time highs again this week, so no real indication of change there. The medium-term model has actually been negative for the last 6 weeks or so. About 6 weeks ago, it turned negative. We have this bearish crossover. This is using the traditional weekly PPO, very similar to the weekly MACD, if you're familiar with that. And that's my basic sort of offense or defense model. When this is in a bullish configuration, it tells me to be thinking more on offense, think more about upside opportunity, make sure that you're capturing opportunities of stocks that are breaking out and riding those trends as much as possible. When you get a sell signal from this model, which we did about 6 weeks ago, again, it doesn't tell me to ignore a chart that looks good. At any moment, I would follow a chart that's breaking out, like an Amazon comes to mind with a big base breaking out of a 10-month base. But when this model's turned negative, which it's been for the last 6 weeks, it tells me to be more on the defensive side, to think less about upside opportunity and more about downside potential. Make sure you have risk measurements in place, stop losses in place, and you protect against potential downside. The short-term model, by the way, has been positive most of the last 4 months. There was 1 week back here about a month ago where it turned negative very briefly and then turned right back positive as we resumed the uptrend. So overall, it said that the short-term tactical trend has largely been positive. This next chart, we're looking at the daily chart of the S&P. We talk about this pretty much every day we review this chart, but I remember particularly with Mark Newton talking about the strength in stocks and identifying some key levels. Mark shared the idea that the May lows, sort of the 40-50, 40-60 range, 40-70, somewhere around here, would be the line in the sand for him. As long as we remain above that, the uptrend is in good place. I don't mind that level, and I think that is absolutely the point of no return. We remain above there, and things can't be that bad. We break that, you really, if you've not already start to really think defensively, I would argue you really should. But what are we seeing now? This week has certainly been a sign of strength. Taking yesterday's drop out of the mix, overall, it's been a sign of accumulation over the course of the week. We're remaining above a trend line that we've been following here for the last 6, 7, 8 months or so. We're remaining above the 50-day moving average. So on any pullback, the question number one is, do we hold the 50-day on a closing basis? If we break that, do we break through the 50-day moving average, currently around 42.20? So if you think about it, getting down to those levels and maybe a little bit below that, the June lows, which are around 41.70, that'd be about a 5% drop from where we're at right now, sort of 4.5% to 5%, I would say. What that means is if we would get a sell-off to that level, that would be very similar to the previous pullbacks that we've seen during this bull market phase so far in 2021 and even before that. That's been sort of the standard pullback. We're about almost 2 months after the most recent pullback, actually right at 2 months since that early May sell-off. That's the last significant pullback that we've seen in stocks. So overall, we are overdue by any stretch of the imagination. I think the overbought conditions on the S&P, the overbought conditions on a lot of the growth areas that have been leadership certainly suggest going into next week, for me, we're overextended and looking for some signs of further weakness. If we do, I think holding those lows around 41.70 is good for me. The final point of no return, 40.70, 40.60, which is the lows from May, would be pretty significant to pay attention to. What else can we review given our time together here in the Wrap the Week segment? The breadth picture is key, and if there's one chart I would ask you to take away, I think it's this one right here. The S&P 500 has made new highs in the last week. The cumulative advanced decline line based on the S&P 500 has also made new highs, so that's a thumbs up. I've changed the color coding based on this transition that I think we are in the midst of. The mid-cap index, mid-cap AD line did not make a new high, but it's not broken down yet, so it's sort of in neutral mode, sort of this neutral amber color. The NYSE common stock only AD line has made a lower high and has broken down through the 50-day and broken down through its low from mid-June. The same set of conditions has happened for the small cap AD line here at the bottom. Why is this such an important combination? This exact combination of the S&P AD line making new highs along with the market, the mid-cap index not being able to do so, but being relatively flat, and small caps and NYSE index, the NYSE exchange, both making lower highs. The last time we've seen that particular combination, February 2020, where the market made a new high January into February. The AD line on the S&P went higher. All these other ones did not confirm, and that non-confirmation was an early warning sign of the exhaustion of that bull market phase that ended in February 2020. And while this does not necessarily guarantee an exact duplicate of that performance, it certainly indicates upside exhaustion potentially, and tells me to pay special attention to breakdowns and lines in the sand. We've had a reduction in the number of new highs looking at the New York Stock Exchange relative to the previous cycles. Interesting to see this week, though, we've actually seen a nice expansion in new highs on the S&P 500. So one of the challenging periods I think you saw through the month of June was the market going higher, but less and less stocks making new highs. It's potentially alleviated here with a good number of stocks, about 15% earlier in this week, making a new 52-week high, which is not too bad. What is concerning on a breadth basis is that only 44% of the S&P members as of Thursday's close were above their 50-day moving average. That is less in a supportive fashion of the overall market going higher. At the April market high, 92% of the S&P members were making a new, were above their 50-day moving average. Right about now, looking at that same measure, it's only 44%. So that's a much weaker configuration.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.